So financial decisions, leverages. Okay. If you are financing by using the debt, then it is called levered firm. What is the advantage of leverage? And if you don't lever, what could be the benefit? So all these things are going to be studied here. In case of leverage, two aspects are predominantly covered. One is all about operating leverage, another one is financial leverage. Okay. So we have two leverages here, operating leverage as well as financial leverage. Combining these two will be called as combined leverage. Okay. Now, sales minus variable cost, you will get the contribution. From the sales, if you subtract the variable cost, you will get a contribution. From the contribution, if you subtract the fixed cost before interest, then it is called EBIT. EBIT. So from there, we have to subtract the interest also to arrive the EBT. Right. And you can subtract the tax. Finally, you get EAT. If you are subtracting the preference dividend, here you will be getting earnings available to the equity shareholders. If you are dividing this by number of shares, then you will be getting earnings per share. Earnings per share. Assume that the sales being 1 lakh, variable cost being 60, then the contribution being 40, fixed cost assumed to be 10,000, then EBIT being 30,000 rupees, and interest being 5,000 and EBT being 25,000. The tax rate could be around 40%, 10,000, and EAT being 15,000. Okay. The relationship between the contribution and EBIT, is called operating leverage. And the relationship between the EBIT and EBT is called financial leverage. If you are combining these two, then you will get combined leverage. You will get combined leverage. Is that clear? So in case of operating leverage, the formula being contribution by EBIT. Contribution by EBIT. In this case, the contribution is 40,000. EBIT is 30,000. Then your operating leverage being 1.33. In case of financial leverage, EBIT by EBT will be taken. EBIT in this case being 30,000, EBT being 25,000. Then 30 by 25,000, the ultimate value here being 1.2. If you are combining these two, 1.33 into 1.2 will be the combined leverage. What is the value? 1.596. Of course, you can use a combined formula also. Contribution by EBIT into EBIT by EBT. You can score out these two, the ultimate value being contribution by EBT. So here the contribution 40,000 and EBT 25,000. Then the ultimate value being 1.596. The same will be getting. Okay. This is also 1.6. Clear? 1.333 into 1.2. The main intention of study of this particular study is, if the number is higher, okay, then you have the opportunity to lever it further. Leverage is nothing but making it faster. In vehicles, you have to change the levers, okay, gear system like. Okay, so anywhere you are using the lever means making the work simpler. That's all. Here also leverage helps us to earn better. You can correlate this with your study also, right? See what happens if you complete your CA or CMA huh, in 2 years or in 4 years. Okay, anyhow, sir, this is success only, sir. But see the magnitude of difference. Magnitude of difference. Fee being registration fee and coaching fee all put together, maybe around 20, around 60,000 rupees, like. And here also 60,000 rupees. And food, dress, shelter for these 2 years and 4 years. We assume it may be roughly around 10,000 rupees per month. 10,000 rupees per month. For 2 years, you have to spend 2,40,000 rupees. 4 years, it is 4,80,000 rupees. Isn't it? What about the revenue? To compare the end of 4th year, if you complete in 2 years, you may get a job for a salary of say 1 lakh. For the 4th year end, you had almost 2 years experience. So into 24 months, 24 lakhs revenue. These two are the cost. This will be the revenue. The ultimate cost being how much? 21 lakhs savings. Don't you want that savings here? And this will be 0 if you don't qualify. Then the cost be 5,40,000 rupees. Am I right? The magnitude of difference between these two is 26,40,000. Come on, tell me. Do you want to become quarter crore badi? 1 lakh. 1 crore is almost 25 lakhs is equivalent to what? Crore badi, at least quarter. So in a matter of 4 years, you become crore badi, closer to crore badi, like. So what happens, the interesting concept. What's that? When you study costing, especially fixation of the remuneration and the Taylor differential piece rate system and all, he says if you are able to, Taylor says if you are able to finish up the job, I give you to complete 10 units. If you complete that in 1 day, time taken being 1 day, you will be paid with rupees 100 per unit. For 10 units, 1,000 rupees will be given. So what's the calculation here? 100 rupees per unit. The same 10 units you have done, completed in 2 days. How much will I pay? So in this case, you multiply with 100, but there's a penalty. You will be offered with only 70% of this value. If you are delaying, that the wages will be adjusted according to the delayness. So you will get only 700 rupees. So you can argue with them, sir, what happens, sir? Anyhow, I completed 10 units only, no. That other fellow, A also completed 10 units and got 1,000 rupees. I also completed 10 units, B. But you are giving me only 700 rupees. For the same job, you have to give me the same salary. Why do you want to differentiate this way? You are penalizing me. Immediately, Tyler says that you are coming and sitting here in our office, right? So we are providing you what? The chairs and table and facilities like electricity and refreshment and all. It costs me 1,000 rupees per day. And in this case, he has completed in 1 day, it costs me 1,000. But in your case, you have consumed 2 days, so it costs me 2,000 rupees. Ultimate cost being only 2,000 rupees in case of A. But in case of B, I am paying you 2,700 rupees for completing the same 10 units. So usually the person who is doing it faster will be appreciated with 120%, not 100. I'll add 120%. So if I add another 20%, by the time also I am saving 2,200 only. So if you are faster, I'm pretty happy because there's a savings in overhead. There is savings in overhead. Those costs not avoidable. Those costs not avoidable. How can you handle that cost? If the cost can be avoidable, you can be double cautious to spend or not. Check whether the spending is really worthwhile or not. You can, based on that analysis, you can spend or not to spend. But in case of fixed cost, not controllable, you are not able to decide whether can I control this or not. What you can do? Fixed cost, you can do it fast. You can do it faster. Rather than completing in 2 days, if he completes in 1 day, the overall cost for the manufacturer being 2,200 for 10 units or 220 is the ultimate cost per unit. But in case B also completed the same unit in 2 days, then it costs us 2,700 for the 10 units. It means 270 rupees. Manufacturer spends around 50 rupees extra for a unit manufactured. Apart from that, the employee is also pretty happy. If he is doing it faster, he gets around 120% of his salary. If he is doing it slow, he gets only 70% of his regular payment. Almost there is a difference of 500 rupees. So A gets 500 rupees higher. Manufacturer also gets a savings of 50 per unit. Both are enjoying. If you are doing it slow, then automatically what happens? It will be spoiler for both, for the manufacturer and this one. So if the cost being uncontrollable, we have to mandatorily spend, then what you have to do? You have to do it faster. Is that okay? So I visit some other location. Probably I may be deputed to work in Delhi for some time. So for 3 or 4 days. For the official purpose, I go to Delhi and do the work. Per day stay that costs me 2,000 rupees. And I can stay a week to complete the job. But for the 1 week period, 7 days into 2,000 rupees, maybe 40,000 is expenses. If I complete the same in 4 days, what happens? 4 into 2,000, 8,000 only spending. 7,000 savings. Then the manufacturer is also happy and he will give the incentives also. So similarly, this fixed cost remains uncontrollable. As this fixed cost remains uncontrollable, what is controllable? The quantity purchased and sale can be controllable. You can either reduce the selling price or promote doing intensive advertisement, whatever it may be, the source may be different. Because of that, if you are doubling this value, okay, if you are doubling this, 1 lakh is doubled, variable cost also doubled, contribution also doubled. But what happens here? EBAT is how much? How much is the EBAT? 70,000 rupees. 70,000 rupees. This one is doubled, but this one is not doubled. It should be doubled plus 30 should be 70, no, but it's not 30 plus 30. It's 30 plus 30, another 10,000 is also increases there. The same logic. If you are able to complete your course in 4 years, it costs us 5,40,000 rupees over the 4 years period. If you complete the same in 2 years, another 2 years you start earn the money. By the end of 4th year, you will be almost quarter crorepati. It's a very interesting concept. So when I started learning all these concepts, no, I listened to a motivational speech on faster is easier. Faster is easier. So anything you do faster, it will be easier. Okay, fixed cost unavoidable. But how can you minimize the cost? You can do it fast. So that the fixed cost of the next day idle capacity will be totally removed. The faster is easier. So you might have seen the karate demonstration to break the bricks. Isn't that okay? Breaking the bricks. So some practitioners started breaking the brick. If they don't apply the exact pressure to break this, their hand may be broken sometimes. It may be painful. Is that okay? Have you experienced anything? Have you tried breaking any bricks? No. So in my days I tried and I tried to break. So with some inertia in my mind, having slight doubt, I give a little bit moderate pressure to break, but the brick will not break, but my pain will be higher. Then I got trained, you just try to break with full force. Sir, even I am trying with a half force, it's very painful. Then they told me, no worry, try yourself. Sir, if my hand broken, what can you do? So never bother. So then I tried once with full force. I didn't get even single pain. The brick was broken. So unless you give the exact pressure, maybe the result may be always pending. So if you are giving half pressure, what happens? If you are hitting the brick with your hand, if the brick is not broken, automatically the power reflected in your own hand, it will be painful. Okay, it's what about Newton's third law, like every action will have the equal and the opposite reaction. So if the brick is not broken, your hand will be feeling the pain. If the brick is broken, what happens then? Huh? The pressure is transferred to break the brick. You will not sense the break its pressure, so it will be pretty comfortable. Sometimes no. So if you don't break, you are not applied proper pressure, the brick will remain as it is without breaking, will be painful for you. If you are demonstrate in front of 10 people or 20 people, if it is not broken, the next moment the people will laugh at you. That will be another pain. That will be another thing. The same happens in case of professional exams. If you don't give the full pressure for passing the examination, the result may be negative. You might have communicated to your preparations to your friends and relatives. The next day result, the next day of result, whether you think it or not, the other people, what happens to the result? With a sarcastic smile, they will start commenting on you, right? So you have to be double cautious. If you give the exact pressure to pass the exams, you can pass the exams in single shot. Then it's a pleasant moment by seeing the result. All the pain you have taken for the passing or it's appearing the examination will be vanishing, and the congratulations statement you receive from various well-wishers will also be double boosted for you. So that's why I always tell you, give the exact pressure. Okay. So if you are able to give the exact pressure, you can win in single shot. That's the logic here in leverage also. To what extent I can increase the sales so that my revenue will be increasing. But if the this operating leverage, right? Sales minus contribution, you'll get sales minus variable cost contribution. From there, you can subtract the fixed cost to get the EBAT. Okay. Now what happens? 1000 rupees, sales being 1000 rupees, variable cost being 600, contribution being 400, fixed cost being 250, EBAT being 150. What about the operating leverage? Operating leverage, C bar EBAT. Come on, tell me. 2.7. Now what happens? Sales being 1000, variable cost being 600, contribution being 400, and fixed cost being 100, EBAT being 300. What about the operating leverage? Contribution by EBAT 400 by 300, 1.33. Is that okay? Now see, if you are doubling this, your sales is doubled. Variable cost will proportionately change, so it will also be double. But contribution also be double. But what about the fixed cost? That remains same. What is the final EBAT here? 700. 700. Is that okay? Now this one is double. What about the situation here? 700 will be the new value. From the 300, you represent that in percentage. Come on, tell me. 233 percentage or 2.33 times. 2.33 times. Is that okay? It means 100% change happens. 100% change. 100% change. What about this one? 400 increase, right, from the existing one. 133 percentage or 1.33. Do you have any connection between this operating leverage and this percentage? Sure, you'll have this one. Okay. Change in sales multiplied with the operating leverage will be the change in the EBAT. Change in sales being 100%, change in operating leverage being 1.33. Otherwise, 133% will be having change. Otherwise, 233 will be the new value. Either you can say that as 233, or you can say 133 increased. So 300 add increase being 133 on this, which is 400. So the new value being 700. New value being 700. Clear? So the operating leverage says the magnitude of the change in EBIT with respect to the magnitude of change of the sales. If the sales has a change of 100%, what would be the change in the EBIT? That EBIT change can be very easily found out by multiplying the operating leverage with the change in the sales. Similarly, in this case, what happens? Sales being 2000 rupees, I am doubling the sales. I am doubling the sales. Then variable cost also be doubling, contribution also doubling. Fixed cost remains same, not changing. Then what about the EBIT here? 550. Now tell me, what about the change in EBIT? Change in EBIT percentage. Almost 400 changed from the base 150. The change being 400 rupees. Increase in EBIT being 400 rupees. Comparing with the existing EBIT, what is the percentage of change here we have? 5.2.67. Otherwise 2.7 times 2.7 or 270 percentage. 270 percentage. So 100% change, but ultimately there is change in EBIT by 270 percentage. Otherwise, you can simply multiply with what? Change in sales with the operating leverage. Change in sales being 100 into 2.7, 270 percentage will be the change. Is that clear? Are you getting 270, right? Maybe fractional change, fractional difference. Okay. I think this one also then it's not 2.7. 400 divided by 150. Yeah, this one is 2.6667. Okay. 2.6667. So then this will be 266.67 percentage. 266.67 percentage. Remember, where the leverage will be most suitable for us? If the leverage is higher, this number is higher, it means the magnitude of change in EBIT will be to that extent of the change in sales. So the magnitude of change in EBIT being 266 can be found out by multiplying with the operating leverage into sales difference. If the operating leverage is higher, even a small change in sales will result in huge difference in the EBIT. Okay, so this will be very important phase when the fixed cost is exorbitantly high. Okay, here compared to this one, the fixed cost in this case is very high, right? Rather than 100 is 250. If the fixed cost is 350, what happens? Then operating leverage is the most highest one. In that case, small change in sales will lead to huge change in the EBIT. Okay, so you can guess what could be the change in the EBIT with respect to the change in the sales. If you are aware about the operating leverage, you can get it easily. So fixed cost is the one of the case. Okay, to reduce the fixed cost per unit, you have to work better. Otherwise, you have to operate faster. That's why it is called operating leverage. Operation. Your operation will decide the EBIT level. If your operation is faster, EBIT will be faster. If the operation is lesser, EBIT is also decreasing. But what extent? To the extent of magnitude of the operating leverage. If the operating leverage is higher, the change in EBIT is also higher. Yes, it will be lower. Clear? Hope now you'll be able to understand this logic. Similar to what? The next one is all about financial leverage. Financial leverage is all about what? In case of financial leverage, sales minus variable cost, contribution, fixed cost, you'll get EBIT minus interest, you'll get EBT. You understand now? So the connection between these two is called operating leverage. Operating leverage mainly focusing operate better so that you can minimize the fixed cost per unit. Financial leverage, of course, you borrowed, for that you have to pay the interest. As you are the borrowing, whether you work or not, you have to pay the interest. You cannot say, sir, I didn't work in this month, I don't pay the interest. Definitely it's not possible. The lender will always demand, I have given the loan in the condition that you have to pay the interest once in every month. So I cannot escape. Is that clear? So if I want to compensate interest, what I have to do? I have to mandatorily work to increase the EBIT. Okay, if the EBIT is increasing, there will be change in EBT also. But what's the magnitude of change? change in EBIT is multiplied with financial leverage will be the change in EBIT. Okay. In this case, what about the change in EBIT? Change in sales multiplied with the operating leverage. Okay. So the change in EBIT will be equivalent to change in sales with respect to operating leverage. We multiply with the operating leverage. In case, what about the change in EBIT? To find out the change in EBIT, you have to find out the EBIT change multiplied with the financial leverage. So if the sales happens 5% change, sir, what could be the EBIT change, sir, finally? It's a combined one. So you have to take up the financial leverage as well as combined leverage, means operating leverage. Clear? Now let's start with the first illustration. It's a comprehensive one where it covers all these things. I will finish up the question number 1 after. Let me try to finish up the question number 2 here. First, let's finish up the basic illustration. The data relating to two companies are given below. Company A and Company B. Equity shares, debentures, output, everything is given. You are required to calculate operating leverage, financial leverage, combined leverage of two companies. Is that okay? Now come on. We'll start with the sales. Company A as well as Company B. Sales 30 rupees and units being this much. So you have to multiply these two. 60 into 30, 18 lakhs. For B, 15 into 250. 30? 37 lakhs 50,000. Yes. From that we have to subtract what? Variable cost. Variable cost per unit is this much. So you have to multiply these two to find out the variable cost per unit. Variable cost, total variable cost. 6 lakhs and 15 into 75. 11 lakhs 25,000. I get the contribution. $12 lakhs. Here 26 lakhs 25,000 minus fixed cost 7 lakhs 14 lakhs. Then we'll get EBIT 5 lakhs and 12 lakhs 25,000 minus interest 12% debenture, so you have to multiply with the 12% the debenture value. 48,000 for A and here 78,000. You'll get EBT 4 lakhs 52,000, 11 lakhs 47,000. Do we have tax here? No, we don't have the tax. Then we can calculate the operating leverage. For operating leverage, we have to connect these two. For financial leverage, you have to connect these two. Operating leverage, financial leverage. If you combine these two, then you will get combined leverage. Degree of operating leverage or simply operating leverage is equal to EBIT by contribution by EBIT. Contribution by EBIT. And financial leverage being EBIT by EBT. Combined leverage being contribution by EBT. Otherwise, it is nothing but operating leverage into financial leverage. You will get that. That way also you can get the same answer. First case it is 2.4, 2.14, 1.11, 1.07, 2.66 or 67, and here 2.29. Cross verify, will you be able to get this answer or not? Come on, text me. Shall I move on to the next one? Now, one of the comprehensive illustrations, question number 1. For complete understanding, I am going to solve this illustration now. Question number 1, calculate the present EPS. Sales per unit, variable cost, fixed cost, debentures 8% debentures 75,000. Tax rate also given, units sold given. Number of equity shares also given here. So sales. What is the current number of units sold? 1000 units. Per unit value being 100. So then the ultimate value being 1 lakh. Variable cost being 60. For 1000 units, 60,000. Contribution in this case being 40,000. Minus fixed cost given as 10,000 here. 30,000 being EBAT. Minus interest. 75,000 is the debenture value, carries 8% interest. If you apply 8% on this, come on, 6,000. The value is 6,000. Very good. So then EBT being 24,000. And tax rate applicable for this company being 40%. 4,000. Do we have any preference dividend? So we don't have the preference dividend. Tax rate. Okay. 40% being how much? 9,600. 9,600. Then I'll get EAT in this case being 14,400. What about the preference dividend? Preference share is missing here, so we don't pay preference dividend. So ultimately earnings available to the equity shareholders in this case being 14,400. Now find out the EPS. You have to divide this by number of shares. Number of shares in this case is 20,000. 0.72 will be the EPS. Clear? Second question, calculate EPS if the sales increases by 20%. Okay. So you can rework out completely. Anyhow, we know the financial leverage and operating leverage that will help us to guess what could be the change in EPS if there is a change in sales, right? So we try to find out the change in EPS using the leverages rather than reworking it completely. Okay, the complete reworking is for the cross verification. For this one, so 1200, you can rework out completely, keeping this 1200 here. But anyhow, the sales being 1,20,000 rupees, but I'm not going to work out this way. I'm going to apply the leverages to cross check. Find out the leverages here. Operating leverage. What is the formula for operating leverage? Contribution by EBAT. What's the value? 1.33. What about the financial leverage? EBAT by EBT. What's the value? 1.25. What about the combined leverage? It's nothing but operating leverage and financial leverage. 1 point, oh, 6625 or 67, huh? Okay, that's 1.33, no. So 1.6667, okay. Otherwise you get fractional difference, that's why, okay. Now the question is, what could be the change in operating leverage? If there is a change in sales by 20 percentage, here the change is 20 percentage. What about the change in EBIT? 1.33 times of this one. Okay, 1.33 times of this one. Multiply these two. 26.66 percentage. Come on, find out the new EBIT. 30,000 into 26.67 percentage. If there is a sales change by 20 percentage, EBIT will change by 26.67 percent. That's how we learn, right? The connection between the change in sales and the change in EBIT can be found out this way. how the percentage change in sales is multiplied with the operating leverage, that will be the change happening in the EBIT. So you add 26.67 percentage. Come on, tell me. How much? 38,000. Okay, 38,000. What about the financial leverage, sir? This is with respect to the EBIT. EBIT change and this one. What is the EBIT change? EBIT change being 26.67. We already found out here. So 26.66667. Better you use the calculator with 4 or 5 digits extra to get correct answer into 1.25. Then this will be 33. Okay. So I have a doubt here. I'm not sure with the percentage change. 33, right? 33 percentage. So this will be 33.33 percentage. Then as the change in EBIT is 26.67 percentage, EBT will have a change of 33.33 percentage. One third. Okay, one third on 24,000. One third on 24,000. 8,000. So 32,000 will be the value. Even in case of operating leverage, it's a connection between sales and EBT. Sales changes by 20 percentage. So here sales into this one. Here EBT into financial leverage. Here sales into combined leverage. This will give you EBIT. This will give you EBT. This will give you EBT from the sales. Now 20 percentage into 1.67. 33.33 percentage. Is that okay? So 24 1000 into 33.33 is also 32,000 rupees. Now you can fill that as usual model. So variable cost per unit being 60 for 1200 units, 1200 into 60. What's the value? 72,000 rupees. I can now subtract 72,000 rupees to get the contribution. The contribution in this case being 48,000. Fixed cost remains unaltered. So earlier 10,000, now also it's 10,000. And yeah, of course, we got the EBAT. So without reworking that statement completely, we can guess what could be the new EBAT if there is a change in sales by 20%. If the change in sales is 20%, definitely EBAT will have the change, that the change is equivalent to change in sales multiplied with the operating leverage. Here the 6,000 remains same. So from 38, if I subtract the 6,000 rupees, you will be getting the EBT 32,000. Our rest of things are the same. Find out the tax at the rate of 40% on this. Hope this will be 12,800, 19,200, and proposed dividend is dash. Earnings available to the equity shareholders 19,200. Number of shares being 20,000. So if I divide this by 20,000, then 0.96. Right. So if I ask you question, if the sales increases by 20%, what could be the change in EPS? What could be the change in EPS? Okay. Can you guess? If the sales changes by 20%, what is the change in EPS? The formula you apply for finding the change in EBT, the same will apply. Thereafter, constantly varying. So here you see 33.33%. One third. 0.72 with that one third, if you apply, you will get 0.96, I think. Right? Hope you will be able to understand. So it is not only to find out EBT, even for the EPS also the same formula will apply. Is that okay? Because these things are proportionately changing. Tax rate 40%, preference dividend also will have the proportionate value. So those things are not having any change. So in the absence of preference dividend, tax will have the proportionate change. So EPS will also have the similar effect as EBT in the absence of preference dividend. If there is a preference dividend, you have to do slight modification. We'll get back that to be discussed later on. So I have completed the three aspects. Now, before I go for fourth and fifth, let me try to finish off sixth one. Calculate financial leverage if the company has 6% preference shares. Sixth option. So the sales being 1 lakh, variable cost is 60, contribution 40, fixed cost 10,000, EB80 30, interest 6,000. I am recopying this one directly. I am going to incorporate one extra adjustment here with respect to the preference dividend here. EBT 24,000, tax at the rate of 40% and percentage on this being 9,600, EAT being 14,400. Here the preference dividend 1 lakh. For that 6% preference dividend is applicable, so you have to subtract this one. Then 8,400 will be the earnings available to the equity shareholders. Now, what about the EPS? 8,400 divided by 20,000? 0.42. What about the operating leverage? Operating leverage remains same. There will not be any change. These two will be called operating leverage. And usually these two are called financial leverage. But in the case of preference dividend, no. These two will be considered as financial leverage. Okay. EBAT as well as earnings available to the equity shareholders. But provided you have to remove the tax impact, so the formula is slightly different here. The formula in this case being, what is the formula for financial leverage? EBAT divided by EBT. Not only that, you have to subtract the preference dividend also. If you borrow, you have to pay the interest. Rather than borrowing, if you are issuing the preference share, you have to pay the preference dividend. Both are same. Both are almost similar to the what? Cost like. But in case of borrowings, interest can be debited to the P&L account. You will have the tax savings. If you are issuing the preference shares and raising the fund, then you have to pay the preference dividend. That will be only after the tax. We don't enjoy the tax benefit. So usually interest component is before tax. Okay, so from the EBAT, I have to subtract interest, I have to subtract the preference dividend. You know that interest being before tax. But this one is after tax. No, how can you subtract? Bring this one also be before tax. To bring this one before tax, what do you have to do? Divide this by 1 minus t. So, making the number after tax, you have to multiply with 1 minus t. To bring it before tax, you have to divide the same number by 1 minus t. Is that okay? So, the denominator is nothing but EBAT minus interest minus preference dividend. EBAT minus interest is EBT, there is no any confusion. Where interest is subtracted, keeping the interest being before tax aspect. Is that okay? But in case of preference dividend, that value is only from the profit after tax is distributed. So you have to arrive the preference dividend before tax. So you have to make this before tax and the formula will be the same. So here the EBAT being 30,000 rupees divided by EBT being 24,000 minus preference dividend before tax being 6,400, after tax being 6,400, to make it before tax divided by 1 minus t, t being 0.4. Come on, get me the value. I think it is 2.14. 2.14. Otherwise, 21.4%. What's the value? Come on. Yeah, 2.14. 2.14. Okay, this one, 1.23. Okay. What about the combined leverage? Very simple. C bar EBAT minus preference dividend before 1 minus t. Before 1 minus t. That's all. Otherwise, you have to multiply these two to get this value. Come on, what's the value? 2.85. 2.85. Finish up copying all. So I have to finish up the question number 4 and 5 with that. Leverage chapter is completely over. To master, we will study additional illustrations as well as I will guide you how the formula is derived. Okay. The operating leverage formula C bar EBIT, financial leverage EBIT by EBT, operating leverage and financial leverage is equal to combined leverage. How do we arrive that? So we'll see that. So we'll be now finishing the fourth and fifth. If you are clear, text me so that we'll move on to the fourth and fifth. Make it faster. C. In case of degree of operating leverage, the formula is equal to percentage change in EBIT divided by percentage change in sales. This is the formula. By simplifying this particular formula, you will get contribution by EBIT. Contribution by EBIT. Is that clear? In case degree of financial leverage, the same. The numerator becomes denominator, and in numerator you will get EBT. Percentage change in EBT divided by percentage change in EBIT. If you are simplifying this formula, you will get EBIT by EBT. EBIT by EBT. Clear? How do we get this formula? We'll discuss that at the last, not now. We'll finish up all the illustration. For the solving the illustration, formula is more than enough. Understanding the derivation will give more grip over that, so we'll finish up the last, right? And degree of combined leverage. If you combine that, numerator denominator will be cancelled, then the answer be percentage change in EBT divided by percentage change in sales. Otherwise, C bar EBT will be the final answer. Right. Now, what about the formula for degree of operating leverage? What's the answer? This one, 1.33, 1.25, 1.67. 1.33, 1.25, 1.67 will be the answer, final answer. Is that okay? Now question number 4. What percentage of change in sales is required to earn 50% increase to EBIT? Now the link is between EBIT change as well as sales change. Which formula you will use here? Degree of operating leverage. For this you have to use degree of operating leverage. In degree of operating leverage being 1.5. 1.33. Percentage of change in sales, denominator to be calculated. Percentage change in EBIT is given, numerator value being 50%. Now, sales percentage change of sales percentage is equal to what? 50 divided by 1.33. What's the ultimate value? 37.6%. Is that clear? If you are making 37.6% change in the sales, your EBIT change will be 50%. Usually what you do, you multiply the percentage change in sales with the operating leverage. The operating leverage being 1.3. We are using the reverse calculations to get that. Is that clear? 37.6 into 1.33 is equal to 50. Otherwise, 50 divided by 1.33 is the percentage change we have to do, so that we will have 50% EBIT change. 50% EBIT change. Option 1. Second one is all about percentage change in sales is what? For what? Required to earn 50% increase to EBT. Now the link is between what? Sales and EBT. In terms of percentage, sales and EBT link is in degree of combined leverage. This is degree of combined leverage. So in degree of combined leverage, this one is degree of operating leverage, this is degree of combined leverage. In degree of combined leverage, the degree of combined leverage being 1.67. In numerator, percentage change in EBT, the percentage change in EBT being 50%, divided by percentage change in sales. Percentage change in sales. Percentage change in sales is equal to, percentage change in sales is equal to 50% change in sales divided by degree of combined leverage. What's that? Or 30% roughly, or 29.9%, 30%. Is that okay? 29.9 or 30%. Okay, you got this. So I got the message from Archu also. Clear? These types of question may be expected, so you need to memorize these two formula set completely. Not only this one, you have to be mastered with this one also, and you need to understand how these the core formula is converted into the ultimate formula. Is that okay? Next one being what percentage change EBIT required? This is what about the requirement. If sales increases by 50%, sales change is given, but we have to calculate EBIT. Then sales and EBIT connection will be founded in where? Operating leverage. So the operating leverage being 1.33, percentage change in sales being 50, then I have to find out this one. Then percentage change in EBIT in this case being 50 into 1.33, 50 into 1.33, 66.67 or 5%. Is that okay? So these two are connected using what? Degree of operating leverage. Degree of operating leverage. The next one is you have to find out what is the percentage of EBIT change if sales is given. EBIT and sales. EBIT and sales comes under what? Degree of, sorry, EBIT and sales, right? Percentage of change in, oh, not this one, EBIT. What percentage of change in EBIT required or will occur if sales increases? Then we have to connect EBIT as well as sales. If I am connecting EBIT and sales, this will be what? Combined leverage. Degree of combined leverage. Sales being 50%, combined leverage being 1.67, then you can find out the degree percentage of change in EBT is like 50 to 1.67. The value being 83.5%. Very often you can come across these types of illustrations. Clear? Almost we have completed all the logics. Mastering this topic could be done by solving few more illustrations. 3, 4, 5, 6, 7. 5 more illustrations are there. All these things are just variations of this. We can finish up everything just like that. There will not be any more complications. So online students, come and text me if it is clear. We'll now go for 3rd, 4th, 5th and all easily. 7 illustrations. All these things can be completed in a matter of half an hour. Okay, then I will explain the formula derivation, the base theory. With that, this topic will be completely over. Leverages is one of the easiest chapters. Okay. Come on. Question number 3. You can try it yourself. Calculate the operating leverage, financial leverage, and combined leverage from the following data under situation 1 and 2, financial plan A and B. So we have two situations, situation 1 and 2. Under that situation 1, we have two plans, plan A and plan B. Okay. So from this, it is very clear. Situation 1, financial plan A. Okay. Situation 1, financial plan or plan A. Next one being situation 1, plan B. Situation 2, plan A. Situation 2, plan B. So we have four alternatives. What about the situation 1? Installed capacity 7,000, 4,000, actual production and sales being only 75%. 3,000 units only sold. Selling price and variable cost is given. As per the situation 1, we have been given two varieties of fixed cost. So sales being 30 into 3,000 into 30, 90,000, 90,000, 90,000, 90,000 and 90,000. Minus variable cost 15 per unit, for 3,000 units 45,000. Is that okay? Then contribution 45,000, 45,000, 45,000, 45,000. Now fixed cost. Situation 1, 15,000. These two are situation 1. And the rest of the two are situation 2. Is that okay? Then what about the EBAT? 30,000, 30,000, 25,000, 25,000. Now you have to subtract the interest. In financial plan A, we have debt being 10 and the rate of interest applicable for that being 20%. If you multiply, then 2,000 will be the interest for financial plan A as well as A. These two are the financial plans A. And in case of financial plan B, 5,000 is 20%, 1,000 for this one as well as here. Then EBT being 28,000, 29,000, 23,000, 24,000. That's all. Hereafter, calculation of operating leverage, financial leverage, combined leverage for these are the options can be done easily. Okay. Operating leverage, contribution by EBAT, financial leverage, EBAT by EBT, combined leverage, C bar EBT. I think situation 1, 1.5, here also 1.5, here 1.8, 1.8. Find out the financial leverage. I think financial leverage for the first case 1.07, second case 1.04, 1.09, 1.04. If you multiply these two, then you will get the combined leverage. Okay, 1.6. Okay, 1.59, 0.5 or exactly 6? Oh, okay, 1.605, I can make it 0 or 6. And this one being 1.96 and 1.87. Clear? Question number 4. Online students, come and respond me. Question number 4. Yeah, come on. What about the degree of operating leverage formula, base formula? Percentage change in EBAT in denominator, percentage change in sales. The ultimate formula being C bar EBAT. The numerator EBT becomes the denominator value. Degree of combined leverage formula being percentage change in EBT divided by percentage change in EBAT. Huh? Sales. No, combined leverage, financial. I'm talking about financial leverage. Degree of financial leverage. Okay. Then the formula be EBAT by EBT. Degree of combined leverage being percentage change in EBT divided by percentage change in sales. Otherwise, the ultimate formula be C bar EBT. Okay, you have to buy hard this formula. That's consider the following information for strong limited. Okay, you have been given EBAT, EBT, fixed cost. Calculate percentage of change in earning per share if sales increased by 5%. Change in earning per share is nothing but EBT, right? If there is a change in EBT, the same proportion there will be change in EPS also in the absence of preference dividend. Already we have studied. So it is the connection between percentage change in EBT and percentage change in sales. So then what formula you have to take? Degree of combined leverage should be taken. So here you need to use degree of combined leverage. Right. So as per this one, sales increased by 5%. The question is what could be the change in percentage change in EBT? If I know the degree of combined leverage, I can get the answer easily. To get the degree of combined leverage, you have to go for this formula, C bar EBT. So we have been given EBAT minus interest, EBT, fixed cost also there, right? Contribution minus fixed cost, EBAT, minus interest, you will get EBT. EBAT being 1120, EBT being 320, fixed cost being 700. So contribution should be reverse calculation, gives us 1820. So as per this one, the formula being C being 1820, EBT being 320. Now come on, get me the degree of combined leverage. 5.6875. So this value being 5.6875. Then what about the final value? 5% into 5.6875 will be the final answer. So even a small 5% change leads to drastic change. 5 into 5, 30 more percentage. Come on, tell me, what's the value? 28. Yeah, 28.44%. Just a 5% change in sales makes huge change in EBT because there is higher fixed cost. Higher fixed cost, higher interest. If these things are higher, then the leverage is also a higher number. If the leverage is bigger, even a small change in the sales will have a huge change in the result. Okay, either EBT or EBT. So finish up copying this. Yes, take your time and get me the answer for the question number 5. At least for A, make it faster. Do you want to copy this? Finished. Online, come on, text me. I request you to try the next question yourself without referring the answer. Clear? Online students, come on, text me. Yeah, try this illustration. Try this illustration. Take your time without referring the answer. Try to get the answer. So from the following, prepare income statement of A, B, C. Briefly comment on each company's performance. Let me try to finish up for A. You can finish up B and C yourself. We have been given the leverages and the income tax rate as well as variable cost as a percentage on sales. Usually income statement is given, we prepare what? We find out these leverages, but here in a reverse case, the income statement usually starts with sales, variable cost, contribution, minus fixed cost, EBIT, minus interest, you will get EBT, minus tax, EAT. Right. Financial leverage is nothing but the relationship between EBIT as well as EBT. As per the financial leverage, you know that it should be 3 times, it should be 1 time. And interest should be 2 rupees. If it is 3, it is 1 means the interest component should be 1. Interest is given here 200 rupees. As 2 share is equal to 200, 3 share EBIT should be 300 and EBT should be 100. Operating leverage is nothing but the relationship between C and EBIT. C and EBIT. This is operating leverage. If the contribution is 4, the EBIT is 1 and the fixed cost is 3. We now found out the 1 share is equal to 300. 3 shares should be 900. Contribution should be 1200. And variable cost as a percentage of sales. If the sales is 100, This will be 66 2 by 3. This will be 33 1 by 3. Otherwise 3 share, 2 share, 1 share. 1 share is equal to 1200 means 2 share 2400 and 3 share 3600. Tax rate 45 percentage and EAT being 55. This was asked in CA final earlier for 15 marks. Sometimes later the same question was asked in CMA final. Now it becomes a part of inter syllabus itself, right? It's very simple. You can finish up B and C yourself. Clear? Come on, make a note of it. Finish up B and C. Let me try for B. Sales minus variable cost contribution. From there you can subtract the fixed cost to get the EBIT. Minus interest, you will get the EBT. If you subtract the tax from EBT, you will get EAT. Financial leverage. What is the formula here? Financial leverage is nothing but EBIT by EBT. If EBIT being 4 share, EBT being 1 share, you know that EBIT minus interest, you will get the EBT. Where EBIT being 4 and EBT being 1, and definitely interest should be the balancing figure 3. Here interest information is given. Interest information is given. 3 share is equal to 300. Then rest of the things can be easily calculated. 4 share 400. So EBIT being 400, EBT being 100, interest being 300. First one is over. In case of operating leverage, formula being operating leverage, contribution by EBIT, contribution minus fixed cost is EBIT. Am I right? As per the operating leverage, C being 5 times and EBIT being 1 time. This is 5 times, this is 1 time. From this, it is very clear the fixed cost should be the balancing figure 4 times. Among the three, now we calculated the EBIT 400. Substitute 400 here. You can do the cross multiplication for the rest. 1 time 400 means 4 times 1600 and 5 times 2000 rupees. So I am now feeding the data here. Contribution 2000, fixed cost 1600, EBIT being 400. EBIT being 400. And next one being sales and variable cost relationship. Sales variable cost. If the sales being 100, variable cost being 75 rupees, and contribution should be 25. Is that okay? Sales minus variable cost. Among the three, contribution we have calculated from the earlier working, so I feed the data here. 25 is equal to 2000 means 75 should be 3 times 6000, and sales should be 8000 rupees. So this one being 8000, 6000, and applicable tax rate 45 percentage 45, and finally EAT being 55. Hope now you will be able to understand this. Clear? Hope now you will be able to finish off C yourself. Let's now move on to the next question, question number 6. Question number 6. Now, a firm has sales 75 lakhs, variable cost 42 lakhs, fixed cost 6 lakhs, sales 75, variable cost 42, contribution 32 lakhs, fixed cost 6 lakhs, EBIT being 26 lakhs. Debt, it has a debt of 45 lakhs and carrying 9% rate of interest. Come on, find out the 9% on 45 lakhs. No, this is 33. This will be 27. Okay. 33, 27. Minus interest. 4 lakhs 5,000. 22.95 lakhs is the EBT. What is the operating, financial and combined leverage? Operating leverage is equal to C bar EBIT. Okay, the relationship between these two, 1 point. Okay, 2. I take 4 digits. Financial leverage is equal to EBIT by EBT. 27 bar 22.95, 1.1764. Combined leverage is nothing but multiplication of operating leverage and financial leverage. 1.4379. 1.4379. If the sales drop to 50 lakhs, what will be the new EBIT? Right. So, sales and EBIT connection will be done by what? Sales and EBIT. Degree of operating leverage. The formula for degree of operating leverage is equal to percentage change in EBIT divided by percentage change in 6. Right. Sales drop by 50,000. What does it mean? Existing sales 75 lakhs drops to 50 means 25 lakhs is going to be decreased. Otherwise, sales drop is equal to change in sales divided by sales existing value. 25 lakhs drops and existing sales 75 lakhs. So, 33.33% drop happens. Now, degree of operating leverage being 1.2222, percentage change in sales being 33.33, then you can find out this one easily. How much is that? 40.73. Okay, 40.73%. Clear? Next question, at what level of EBT of the firm will be equal to 0? Okay, so now you are making the EBT to 0. Current EBT is 22.95. To make it 0, 100% 0, reducing. Okay, the change here being 100%. Okay. Now, what could be the change in sales? So, it's connection between sales and the EBT. For connection between sales and EBT, what leverage will be taken? Degree of combined leverage. Degree of combined leverage is equal to percentage change in EBT divided by percentage change in sales. Now you know that degree of combined leverage being 1.4379 from here, and EBT change being 100%. Then what about this one? 100 divided by 1.4379. 69.54%. So, what is the existing sales? How much you have to reduce? 69.54%. Come on, tell me. 52 lakhs, 15,500. So, if the sales decreases so much and new sales being 22,84,500. If the sales being 22 lakhs 84,500, your EBT being zero. Your EBT being zero. Around 70% decrease in sales makes the EBT zero. That's the logic. Is that clear? Question number 7. The financial highlights of Amtech Limited for the year 2007 and 8 are as given below. Calculate the degree of financial leverage. So we have been given EBITDA, depreciation and all. So EBITDA, $830 crores. Earnings before interest, tax, depreciation and amortization. Any amount related to non-cash expenses like depreciation and amortization can be subtracted to get the EBIT. 824. From the EBIT, you have to subtract the tax, interest. Here the debt equity ratio being 1:5:1 means debt to equity. If the debt being 1.5, equity is 1. Here, number of outstanding shares being 33. Book value per share is 30. If you multiply these two, 990 you have. This is called equity. So, this equity being 990. Come on, find out the debt now. Do the cross multiplication to find out the debt component. How much? 100 and 1485. 1485. And applicable interest rate not given. EPS is given. So EBIT minus interest will get EBT. We don't have the preference shares. If the EBT is divided by the number of shares being 33 crores, you will get the EPS. EPS being 30 per share. 4 per share. Okay. Then if you multiply these two, you will get what? EBT 132. This will be the balancing figure. As rate of interest not given, if rate of interest given, then I can use that directly here. As that one is missing, I can calculate the interest as a missing data. Oh, this is EBT, no? Right. One second, one second. EBT. From there, I have to subtract what? Tax. Tax is also there, right? I missed. Then EAT, number of shares, 33 crores, and EPS being 4. If you multiply these two, you'll get the tax, which is 132. Tax rate being 30%. If the EBT being 100, tax is 30, EAT being 70. 132 is equal to 70 share. Then what about the 30 share to find out the tax? 56.6 cross multiplication. Then EBT should be reverse calculation. 132 plus 56.6, EBT being 188.6. And the balancing figure for interest, how much is that? 635.4 will be the interest. For financial leverage, the formula being these two, right? EBT, EBAT by EBT is the financial leverage. EBAT being 824, EBT being 188.6. Come on, get me the financial leverage. 4.37 is the answer. Next question, what is the financial break-even point of Amtech? Already we studied the financial break-even point along with the capital structure chapter itself. Okay, financial break-even point formula we learned earlier is equal to interest plus preference dividend divided by 1 minus T. How much I have to earn at least minimum to satisfy the fixed commitment like interest as well as preference dividend. If there is no preference dividend, no problem. Just to start earn to the extent of interest. In case of preference dividend, after tax only you have to pay, no? So you have to make it before tax. So here we don't have the preference dividend. So here financial break-even point is all about only the interest component. That interest is equal to 635.4. So your earnings before interest and tax should be 635.4. That's all. That's what about the financial break-even point. What would be the impact of EPS if EBAT is increased by 5%? The connection between EPS and EBAT, what leverage will be taken here? EPS and EPS is otherwise called as EBT. So EBT and EBAT connection is used for financial leverage. So degree of financial leverage is equal to percentage change in EBT divided by percentage change in EBAT. Here we have been given the financial leverage, which is 4.37. We got this value here. Now the question is, EBAT is increased to 5% means this is given. What about the change in EBT? We have to calculate in a reverse case. Right. So 5 into 4.34. Yeah, roughly 22% change will happen. If the change happens in EBAT at the rate of 5%, definitely it leads to 22% increase in EBT. Is that clear? I have chosen this illustration because it requires slight understanding like background calculation as well as missing data calculations like that's why I just included, else the sum is very easy. With that, all the illustrations of leverages chapter is over. I request you to try the additional illustration from the past year's question paper collection already available in Singar Academy site. Just download and try to solve the illustration without referring the answers, right? If it is clear, text me. We'll go for discussing the derivation part. Make it faster. Now let's see. Let's see the derivation part here. In case of degree of operating leverage, okay, the formula being percentage change in EBIT divided by percentage change in sales. How will you calculate the percentage change in EBIT? Change in EBIT divided by the base EBIT. If the EBIT being 1 lakh, suddenly it increases to 1 lakh 20. What is the percentage of change? 20 divided by 1 lakh, 20% change. That can be calculated this way. Whole divided by change in sales quantity divided by existing quantity. This is what about the formula. Okay. Now, tell me, what is the formula for EBIT? What is the formula for EBIT? Sales minus variable cost is the contribution, multiplied with the number of quantity is the total contribution. From there, fixed cost is subtracted to get the EBIT. I got this value. This value is over. In the numerator, change in EBIT. Sales minus variable cost into change in quantity minus change in fixed cost. Okay, change in fixed cost. Now I got this value also. In denominator, we have this value. Rather than this is being the denominator, you can convert that into the multiplication form, inversing this quantity by this one. What about the change in fixed cost? What about the change in fixed cost? The change in fixed cost is 0, right? Once you spend 1000 rupees by working additionally, you don't spend any money extra for the fixed cost. That remains constant. So the incremental fixed cost is 0. Okay, then you got this value. Here, this change in quantity and change in quantity got eliminated. The ultimate value being sales minus variable cost into this Q divided by sales minus variable cost into Q minus fixed cost. Sales minus variable cost into Q is nothing but contribution. Sales minus variable cost into Q, contribution minus fixed cost is nothing but EBIT. Hope you will be now able to understand this derivation. Clear? First part derivation is over. The same way you can calculate for financial leverage also. For the financial leverages, degree of financial leverage is equal to percentage change in EBT divided by percentage change in EBIT. Percentage change in EBIT. So, degree of financial leverage, percentage of change in EBT is nothing but change in EBT divided by existing EBT whole divided by change in EBIT divided by EBIT. This is what about the degree of financial leverage. Otherwise, change in EBT divided by EBT into EBIT divided by change in EBIT. Is that okay? Now find out the EBT. EBT is nothing but this one, denominator. Sales minus variable cost into quantity is the contribution minus fixed cost. You will get the EBIT minus interest, you will be getting EBT. In numerator, change in that. So, sales minus variable cost into incremental quantity, change in fixed cost, change in interest. Is that okay? And in case of EBIT, for this sales minus variable cost into quantity, contribution minus fixed cost will be the EBIT. In denominator, sales minus variable cost into quantity, change in quantity minus change in fixed cost. You are aware about that change in fixed cost will be 0, change in interest also with 0. Now you can summarize this entire formula. Here the numerator being sales minus variable cost into change in quantity. In denominator here we have the same value. Okay. So then what happens? These two can be completely cancelled. The ultimate answer being sales minus variable cost into quantity minus fixed cost divided by sales minus variable cost into quantity minus fixed cost minus interest. So this will be contribution. If you subtract the fixed cost, then you will be getting EBAT. From the EBAT, if you subtract the interest, then you will get EBT. Hope you will be now able to understand the derivation of these two formulas. Clear? Of course, derivation is not a matter for you, not required also. Anyhow, in case of financial leverage, if we have what? Preference dividend, the formula will be slightly different. Denominator, you not only subtract interest from the EBAT, you will have to subtract what? Preference dividend also. But while subtracting the preference dividend, it should be brought to before tax item like divided by 1 minus t. That's the formula here. If you multiply these two formula, you will get what? Combined leverage. Combined leverage. Clear? Now, that's very interesting formula here. If you are aware about the margin of sales, margin of safety. What is the formula for margin of safety? So, sales minus BEP is the margin of safety. Am I right? Sales minus BEP will be margin of safety. Okay, sales being 1000, total sales, BEP sales being 600, then margin of safety should be 400. If I ask you, what about the margin of safety percentage? This is nothing but 400 by 1000, 40%. It can be written this way: sales minus BEP sales whole divided by sales. That's how you can represent the margin of safety also. Out of the total sales, 60% BEP means 40% margin of safety. So when I start the cost and management chapter, so first chapter will be this one only. Okay, marginal costing, where you will understand this concept in detail. If you don't understand, no problem, you just mug up this. Along with that chapter, marginal costing, you will understand this bit easily. Now, sales minus BEP being margin of safety 6, the 400 numerator divided by sales being 1000, so 40% will be the answer. Clear? Here, margin of safety is equal to sales minus BEP by sales. I am multiplying it both the side with the PVR. PVR, profit volume ratio. PVR is nothing but contribution by sales into 100. Sales minus variable cost, you will be getting the contribution. The relationship between the sales and contribution is the PVR. Is that okay? So, PVR is equal to sales minus variable cost contribution. The relationship between these two is the PVR. Clear? Now, if I multiply the PVR in both the sides, sales into PVR minus BEP into PVR, and in denominator sales into PVR. Sales into PVR. Okay. Now, what happens if I multiply sales into PVR? Sales into PVR, you will get the contribution. So, this value is nothing but what? Contribution minus this value is nothing but what? Contribution. If you multiply PVR with BEP, what will you get? Usually you will get the fixed cost. You will study along with the marginal costing chapter. Okay, this will be called fixed cost. Okay, come on, tell me. From the contribution, if I subtract fixed cost, what will you get? EBAT by C. Clear? EBAT by C. So, MOS is nothing but EBAT by C. You know that the financial leverage is nothing but C by EBAT. It's inverse. So, hence, financial leverage is equal to 1 by MOS. That's all. If the MOS percentage is given 40%, like 1 divided by 40% will be the financial leverage. You no need to understand the derivations now. Once you finish up the marginal costing, you can easily understand, no issues. After that, the main thing that you have to understand here is degree of operating leverage is this one. Sorry, this is operating leverage. Sorry, operating leverage. So, degree of operating leverage is equal to 1 by MOS is the other way of representing the same idea. Same idea. So, you have to memorize the operating leverage, financial leverage, combined leverage, the basic formula, the percentage change based, no, that is called basic formula. The sum means the derived one being the C bar EBIT. You have to understand these two. And you need to understand the operating leverage is equal to 1 bar MOS. 1 bar MOS. How, sir? In order to prove that just you understand these steps, otherwise not required. We learned all these things. Leverage is nothing but used debt in the capital structure is called levered. So a company has debt component in their capital structure, then it is called levered firm. And we have the two risk classes. One is business risk, another one is financial risk. Financial risk is nothing but you borrowed, but you are not capable of giving the interest, then you have to answer them. Your business may get collapsed because of the default of paying this. This arises only due to the interest component, no. So that interest component is studied under financial risk usually. What is that? Financial leverage. Business risk is nothing but the business is picking up or getting stuck because of the market situation. So those things are affecting the EBIT. We are not bothering about the interest concept. So this is called business risk. So business risk is all about operating leverage. Financial risk is also about this financial leverage. So you have to monitor the operating leverage as well as financial leverage clearly so that you can handle these two much better way. Is that clear? Hope you will be now able to understand the financial decisions of leverages. Right. Finally, a small summary. What about the operating leverage, sir? Operating leverage. Contribution by EBIT. If the contribution is 1000, EBIT is 200, your operating leverage is 5. If the contribution is 500, EBIT is 1000, what happens? This is 0.5. This is the weakest situation, you have to close the business. Is that okay? Clear? Sometimes EBIT being 0. Okay, indeterminate. That is given here. If the contribution is less than fixed cost, operating leverage should be less than 1 in some cases. If the contribution is more than fixed cost, then operating leverage should be more than 1. If the operating leverage is more than 1, then the magnitude of change of the revenue with respect to the sales will be higher. Is that okay? This is the main thing you have to understand. The rest of things just a relationship understanding. Okay. Not more than that, you don't need to worry about this fixed cost and all other things. All we have already studied along with the illustrations. Now, if you apply those things, you will understand the logics and relationship also easily. Clear? That's all. So with that, all the concepts are over. You can note it down for better understanding. Okay. With that, we'll conclude the leverages. Next chapter being the ratios will start in the next class.